All right, big banks kicked it off last Friday. Earnings season is underway. Some of them, even with a double beat, sold off. What do we need to know about the group? Suryansh Sharma is with us, equity analyst, real estate, life insurance, and U.S. money center banks at Morningstar, and David Ellison, portfolio manager of the Hennessy large and small cap financial funds. Thank you both for being with us. So, David, I'll start with you. What's the takeaway thus far? I know they're all not the same exactly in what they do. However, how do you feel so far in what you've heard from the banks?
Well, I think I've heard that, everything is pretty much in line. I think that, the concern continues to be credit, which is, they say it's normalizing. That's sort of code for non-performers are rising slowly. And that seems to be happening across the board. The other issue is the loss of non-interest-bearing deposits that is potentially putting pressure on the long-term margin outlook. And of course, you throw in the fact that, rates have moved up, seems like every day the last week or so is sort of making people think, well, if this continues, the deposit pressure is going to continue, credit's going to be worse. So we don't have a great macro backdrop to be earning or reporting earnings into.
All right. That being said, I'd like to hear some of your calls here today, Suri, on some of these names. Which ones may be the buy ratings and why?
Yep, for sure. So for us, I think with respect to the larger money center banks, we think that Citibank is around 15% undervalued. Bank of America is around 10% undervalued. We think, contrary to the street, we think JP Morgan is 10% overvalued. But given the risk-reward perspective, we think Citibank is currently in a turnaround, and there are substantial uncertainties associated with the name. Given that, we like Bank of America best out of the four money center banks. And the story with Bank of America is that in 2020 and 2021, when there was a large amount of liquidity pumped into the system, there was abundant cheap deposits available. At that time, Bank of America took a lot of duration risk. What that means is it took those really cheap deposits and then it put it into hold-to-maturity securities or long-duration securities. At that time, the long-term interest rates were quite low. So now these securities are stuck on your balance sheet, earning quite low yields. Now, this is the reason that coming into the interest rate cycle, as interest rates were going up, Bank of America was less asset sensitive than its peers. And this is the main reason that we think that Bank of America has underperformed, especially with respect to JP Morgan. So just to give you some context, Bank of America is currently earning NIMs of around 2% compared to JP Morgan of 2.7%. That's a difference of 70 basis points. And when the difference is on an asset base of trillions of dollars, that's a pretty large difference. So our thesis is that Bank of America underperformed when interest rates were going up because of the way the balance sheet is positioned. But when interest rates come down, on a relative basis, Bank of America will outperform.
So it's interesting because, Suri, you did say that Citibank and Bank of America were underappreciated and probably had some upside potential to the tune of 15%, 10%, whereas JP Morgan was overvalued. What about Bank of America? Is that sort of undervalued at this moment, Suri?
Yeah, with Bank of America, our thesis is, as I said, it is around 10% undervalued. And I want to make sure I heard it right. You wanted to ask about Bank of America, right?
Bank of America, yes.
Yeah,
BAC.
Yeah. So with Bank of America, as I was mentioning, I think the story remains that it was under-earning, and now it will catch up with its peers.
Look, I mean, we talk about loan growth being tepid. I know we're trying to focus on the big money center banks because the regionals have their own issues when it comes to commercial real estate. We've seen some charge-offs from all the banks, at least in that area. But net interest income, you've both been looking at that. Is that trough here in the second quarter? Do things get better? David, which names or types of names seem to be the standouts for you?
Well, we haven't seen a lot of the smaller banks yet. We'll see that, the rest of this week and next week. I think I tend to favor the bigger banks because I think they're more diverse. We know that they have less exposure to the cost of funds, especially deposits, which are becoming, I think, something that really is the sea change here since Silicon Valley and First Republic of last year. So I think the industry is in transition, is trying to figure out what its cost of funds is going to look like. Again, I think what we're seeing is a continued loss of non-interest bearing deposits out of the industry.
Right.
And that is the big golden egg that they've had for decades. I've been doing this for 40 some odd years. And if that golden egg is going to start to shrink, it's going to put pressure on the whole industry in terms of long-term returns. But in the meantime, the companies are doing fine and credit's deteriorating. We all know that. Margins hopefully are going to bottom this quarter or next quarter, but it depends on rates. So you've got a macro call there. And we need to work through credit and work through what rates are going to look like and what the yield curve is going to look like. So we sort of, they're doing okay, and we'll check in next quarter.
We still have a lot of the regional banks, as you mentioned. We'll have U.S. Bancorp, DFS. We'll, so many of these names. You also did mention, David, that you expect more bank failures. And so that could be problematic for the group as well. I think I'll give you 10 seconds on that very quickly, David.
The smaller banks are more concentrated. We know we have a problem in commercial real estate. That's going to, especially office, that's going to be with us. And there are a number of banks that are too exposed there, and it's too late. They've already made the loans.
All right. Suryansh Sharma, Morningstar. David Ellison, the Hennessy Large and Small Cap Financial Funds. Thank you both very, very much. Keep focusing on those banks, especially look what's been going on with yields.